Hey, welcome back to So Ready Podcast. So today we're joined by Rick, the founder of the Fuel Break Capital Partners. So Rick brings on 35 years of experience across distressed investing, restructuring, bankruptcy, M&A, operational turnarounds, and special situation advisory. So over the course of his career, he's worked across private equity, debt capital markets, merchant banking, and operational leadership, helping companies navigate most of the critical moments in their life cycle. So, Rick, very excited to have you here. But just give us a quick overview of your background and what you're focused on today.
So I started early on in my career as a large firm corporate bankruptcy and restructuring attorney. I had an MBA as well, and I had a kind of in the back of my mind an idea that I would start in law and kind of transition to the business side, and that's essentially what I did. I got a solid base in bankruptcy and restructuring law, went into in-house counsel, so I was general counsel of a couple of large distressed asset investment, liquidation, appraisal firms. I went from there to kind of the distressed investment side. Did a little stint on, I call it my Rip Van Winkle, to say, like 6 years of being kind of out of the distressed side of the world, out of the investment side of the world in private companies. Did a little operating stint as a COO and head of acquisitions for a brand marketing and tier one supplier to Ford and GM. I ended up merging that company with a larger public company. I went on to run their corporate and entertainment licensing and got kind of pulled into the early stages of I'm an old guy, the internet in the late 90s. Did a couple of internet startups there. And then when the dot-com bust came about, I had 3 kids, and I said, I can't wait around for the internet to come back, and went back into the distressed investment side. And eventually, prior to the great financial crisis in 2008, formed Fuel Break Capital Partners with the idea that I would get involved with companies really struggling through that great financial crisis, helping them using my distressed investment and restructuring background to kind of help them navigate through and avoid a complete meltdown. Been doing
Wow.
that since 2008. It's kind of morphed into a broader based special situations capital and restructuring advisory firm. And that's a fancy way of just saying I help companies, individuals, firms, platforms that are seeking capital that doesn't fit into the general bounds and parameters of traditional bank, corporate finance, and or private equity financings.
Yeah. Okay. Okay. Great. And you say you help those specific types of people look for different lending options outside of the traditional ways of getting financing for their business. What typical strategies are your approach are you typically taking?
Well, when I'm working with most of these companies or platforms, they have a story. Some of them are a story like they, have troubles, they're restructuring, they're working through issues. Some of them are just different. They're unique. They don't fit the normal structures. So sometimes they're a group that's buying distressed loans. So it's not technically an operating business, but obviously is in the operations and active operations of loan portfolio acquisitions and workouts. Sometimes they're a unique specialty finance company. It's a lot of these groups, the key to getting them financing is kind of twofold. One is telling the right story to the right group of people. So letting them get their arms around something that's on the surface is a little bit harder to understand. Two, giving them kind of the unique aspects of the business and why it makes sense for them to dig in a little deeper and try to be creative in the way they structure. And the third is candidly the hardest part is getting my clients to accept the market realities, which doesn't often connect with their view of what their company's worth or the cost or structure of the capital that they should be taking on. So
Right.
I always say it's like putting a Jenga puzzle together, which is hard enough. And sometimes, particularly in kind of today's world where there's just so many macroeconomic and exogenous events, it's a little bit like putting a Jenga puzzle together in a hurricane.
Yeah. Okay. And I know you mentioned you worked across the different terrains regarding distressed investing, restructuring, and M&A for decades. So, like, what are the biggest patterns you consistently see in companies that eventually struggle or fail?
Well, on the, I'll divide it. So the companies that I think that end up failing, more often than not, it's a lack of objectivity and perspective. It's, making mistakes and then not seeing the the error of their ways and having the experience and objectivity to make some tough decisions. A lot of times they're family businesses. You may have a family member who is in a very senior position, he or she, but they may not actually have the background experience. As the business tends to grow, it often outgrows the skills and experience of the family members. It's often not professionally managed. And when that happens, you often have, round pegs and square holes. You have people who are, don't have the skill and experience to navigate the complexities as a business starts to grow. So what often makes a founder or family business successful in the early stages, sometimes they just get caught in that transition, not, growing and expanding and getting some outside independent voices. So, sometimes you get in that echo chamber of the family business or the entrepreneur's business, and you don't end up seeing the bigger picture because it's the classic, can't see the forest for the trees.
Yeah. Yeah, makes sense. Makes a lot of sense to me. And
And
and go ahead.
no, I was going to say, so that's kind of the distress side. And the companies that often struggle with growth or on a sales side, it's usually just not appreciating the market realities. So sometimes more than sometimes, more often than not, a company is trying to sell for an unreasonable number, believes some kind of valuation because they read something somewhere, or some investment banker, just to try to obtain the business, sells them on some, unreasonable multiple, not based on current data or any kind of real, true benchmarks. It's just, somebody reads that somebody else sold their business for 12 times EBITDA. So they think their business is worth 10 or 12 times EBITDA, when maybe in that industry, the real market standard is 5 or 6 times EBITDA. And what ends up happening in a lot of these processes is either selling or financing is the capital is available, or a purchase offer is made, but these companies sometimes miss the opportunity. They think there's a bigger payday, or they think there's a cheaper financing, or they think there's a better structure around the corner. And more often than not, if you run a good process, the market speaks. And that,
Right.
I always tell clients, you don't have to like reality. You just have to understand it, accept it, and work with it, because you're not changing reality.
Yes, I love it. I love it, and that's the truth, honestly. And as a business owner, you have to have that flexibility and be able to navigate in those moments. And I know you're working with with the distress side. Let's focus there for a second. And you spent decades seeing companies during distress situations and states. Like, how often do operational inefficiencies or maybe lack of systems really contribute to that business losing value?
Probably more often than not. The interesting thing about being kind of on the distress side and the bankruptcy side, it's a little bit of a forensic exercise, almost like CSI bankruptcy. And you see the train wreck, and you have to piece together what happened. Sometimes you get it before the train goes off the tracks completely. Maybe it's just derailed. It hasn't gone off the side of the bridge into a gorge and never to be seen again. But what you often see is, a series of errors that compound on themselves. And, companies often are very slow to accept the issues facing them. And if you don't have good systems, particularly financial data, it's pretty hard to recover from series of errors. And if you're a smaller business, you have a lot less running room and a lot less wiggle room. A couple of small errors in and of themselves may not be catastrophic, but as you know they mount, they become exponential. And it's the classic kind of snowball rolling down the hill. It gains steam, and many companies are very slow to make adjustments. And if you don't have good structure, good systems, good management, particularly management that's been through some of the trials and tribulations, it's often hard to adjust and pivot. And sometimes there's market situations like COVID that, there's just almost nothing you can do, no matter how
Uncontrollables.
experienced you are. But if black swan type event out, and you're just talking about certain, market downturns or market softness, the companies that are on top of their information and have real good structure and real professional management, those are the ones that tend to be able to weather the storm and navigate through to the other side. The ones that don't often get caught, and unless they can bring in experienced independent, objective turnaround consultant or an interim manager, they often aren't able to survive. The second part of it is financial. Sometimes you just are over levered and you have a financial, a overly costly or unwieldy financial structure. Sometimes you can clean that up in bankruptcy or an out of court restructuring or workout. Those tend to be a little bit easier to work with than a pure operational or market, real serious market weakness or a market issue. Sometimes you can't solve for that. Sometimes in bankruptcy you can, but more often than not, the financial restructurings tend to be the ones that get successfully restructured and exit bankruptcy. The operational ones can be fixed, but if it's real small, it's hard to attract the right capital and talent to give you enough time to work through those issues.
Yeah, yeah. And so let's say, what are some like early signs or warnings that a company is even heading toward distress, right? Even if revenue looks healthy, like if revenue is looking healthy, what are other signs that they can look for?
Uh, Depending on the business, but it can be your payables. Like if your payables start to really stack up and your payable period of time periods extending, that's certainly a warning sign. Even if you're really profitable, you can have a serious cash flow issue if you're on the wrong side of the payables, particularly with critical vendors. Another issue is sometimes collections.
Mm.
Not every business has a receivable pool, but businesses that have receivables often aren't great about staying on top of the collections. And sometimes, particularly if they feel like there's a good customer, they'll let the customer have extended terms. And, sometimes that's a good idea. But if you continue to do that and your payables start increasing, you get on the wrong side of that cash flow curve. And
Oh, yeah.
and that's certainly there's sometimes there can be concentration issues. I find the private equity world a little bit one size fits all on the wrong way. They think concentration is all bad. It's not
Uh,
necessarily true. But if you do have a large customer and that large customer is a big percentage of your business, you can get kind of enamored with growing that business and not pay attention to margins and the true operating costs of supporting that customer. And that
yeah.
customer can potentially have enough leverage over you to cause you real issues, particularly if they start aggressively pushing back on pricing, to a point where you're not able to adjust quickly enough to either cut costs or increase your own pricing to make up for the fact that that large customer is, put you in a bind.
Yeah,
So
yeah.
it's kind of a double-edged sword. Sometimes you really want to be very important to a, a large customer. That's not necessarily a bad thing, but if you don't take steps to kind of try to broaden your customer base, you can get caught in that, not to pick on them, although they certainly have caused a lot of pain to people. There's a lot of companies that Walmart put into business and put them out of business.
Yeah. Yeah.
They got them to invest in, people and facilities and production, and they put these big orders or dangle these big orders in front of them. All of a sudden, they either decide that they're not selling and they put everything back to you, and they cut your pricing. They cut the marketing side of the business at the store level, and most businesses can't adjust to that type of wild swing in cutting of revenues and cutting of prices.
Yeah, and I actually noticed this happened with one of my clients, right? One of my clients, they had a dependency or really a large concentration on one affiliate partner. The affiliate partner sends over a lot of their leads, their revenue as well, but the affiliate partnership ended. And so if you don't have a control of your own pipeline, that does really disrupt your own valuation and the growth of the company. I agree with that as well.
Right. And so, one there's I heard an investor once say this to me, and it made a tremendous amount of sense to me. He was an operator investor, very successful. And he said, "Don't worry about your exit. Focus on profitability." And a lot of times companies, now it may not be as applicable to founders. Well, it could be depending on the industry, but it's often when you get, the first acquisition and that acquirer is trying to grow the business. They often are too fixated on what their exit's going to be, and they're not paying attention to making the business as efficient and profitable as possible. Now, it doesn't matter if you're exiting or not. If you create value, you will have options. whether they're
Yep.
exits, whatever that exit may be, merger, sale, refinancing, bringing in new investors. If you grow your business and you focus on profitability and operating efficiency, good things
Mhm.
happen. And it's sometimes it's easy to lose sight of it because you get caught up in the, classic keeping up with the Joneses. You see other companies doing certain things, or you get envious of their growth, or you see somebody with a great exit and you're like, I want to mimic that. It's easier to mimic if you focus on the essentials and the fundamentals and not get fixated on the payoff.
Right, right. And so it's a never-ending balance between profitability and operational efficiency. Yeah. So, Rick, I have a question here. Why, distress or distress environments? What opportunity are you seeing with distress environments for people who are unfamiliar with that world?
Well, they tend to be somewhat cyclical. And sometimes they're just industry cyclical and sometimes they're market cyclical, right? So there's some large, obviously in a recession, you're in a big distress period, but you
Mhm.
could have industries that go through their own distress periods, even when the broader economy or markets doing fairly well, if not even growing rapidly. So, over the years, a lot of money's come into the distressed investment side. But when I started out, it was largely, kind of the path of resistance. People didn't. They were uncertain, particularly in bankruptcies. They were afraid. They hadn't been there before. They didn't know how to navigate in bankruptcy. Particularly strategic companies did not want to be involved in a bankruptcy, and so there were opportunities for non-strategic buyers, financial buyers, people who had come out of or had had some experience in the bankruptcy and restructuring world. It was less trafficked. So you had less competition. You had people who were, not as experienced. So they were, reluctant to get involved. And therefore, with less competition, you had better pricing. And, there's a old saying, you don't make money in a distressed deal unless you buy it right. Right. So you can
Okay.
never make it work if you pay too much. So one of the keys in a distressed environment is understanding if you can fix something and you can get some real value. If you know what you're doing, you know how to navigate a process, you have the ability to get underneath the hood and do the repairs yourself, or, have a partner who can do the repairs and really work and right size the company and put it back on path. You can obtain some significant value. So, you can use a lot of metaphors, but, you can buy a new car and pay full retail, or you can buy, if you know what you're doing, you can buy an older car that needs some work, but people are afraid to do the work. So you get a real great value on that car. It takes a little time, it takes lot more effort, but you can get a greater reward, particularly if you get maybe a car that's a collectible car. So
Yeah.
sometimes there's hidden value that can be extracted, and it's real hard in today's world if you're an investor. I'm not talking about a company side.
Uh-huh.
It could be great to be in a hot market where an investor, even if it's not distressed, it's very hard to pay a significant multiple and still make money. You can get lucky, but generally what happens is if luck is a part of your business plan, it's a bad business plan.
I know that's right.
People make big mistakes and still make a lot of money, but
Yeah.
sometimes they fall in the trap of thinking that they did something right, not recognizing what they did wrong. And that cuts across the world at large, but in the business world, just because you got lucky doesn't mean you did the right thing and that you should, count on your luck or ignore the fact that you got lucky and you should do things differently the next time. And broadly speaking, if you're a private equity firm doing the same thing and there's tremendous amount of money, lower middle market, everybody's looking for the same businesses at the same, revenue
Great.
levels, the same EBITDA.
Mhm.
And, if they're a financial buyer with no real angle, either they have a platform or they have an operator or they have some angle to pay 10 times and then try to grow it and sell it for 10 times and make money is, I think it's a fool's errand. There's doesn't mean that people aren't going to keep doing it and people aren't going to keep making money at it, but I think it's a lot harder to do that than to try to find something that isn't optimized and find a way to optimize it and then sell it.
Right. Yes.
You buy something that's scratch and dent and you clean it up and you brush it up and you burnish it and you do the right thing and you find the right time and you sell it at that point. There's a lot more value. to be created.
And I like that. And I mean, to kind of, I want to go a bit deeper there. How do you think founders should think about debt, leverage, and raising capital in today's environment compared to maybe previous cycles?
It's a very good question, and I don't have a great answer in today's environment because it's very opaque and uncertain. This is one of those environments that is very hard to evaluate because if you look at the stock market, it's still pretty high.
Yeah.
But if you look at the underlying reasons why the stock market's high and you start to look at other parts of the economy and you start to look at what people's actual experiences, there's a big disconnect between the robust stock markets and the what I believe is the true health of the economy. And so what happens in those markets in that uncertainty, it's often hard to do two things. One, sometimes it's hard to attract capital or to obtain debt. And debt can be a bad word, but it's not necessarily a bad thing. I tell clients sometimes if debt's available and you believe in your equity, you believe in your ultimate value, and you can use the debt to grow your business and or, get to a certain level or to do an acquisition or something that's accretive, debt becomes cheap equity, even expensive debt. Opposite may be true. If you have the ability to raise equity at a very favorable valuation, maybe you should take it.
Yeah.
But I've also and forsake debt. But I believe that debt can be a very powerful tool if you use leverage correctly. Obviously, if you use leverage incorrectly, it can be a real problem. But
Understood.
sometimes people are afraid of debt, and you shouldn't be categorically afraid of debt. You just have to use it wisely and figure out how to deploy it properly. And sometimes taking a more expensive piece of debt that provides much more liquidity and provides some longer term and some flexibility can be very powerful. Sometimes people get caught up in saying, well, I'm going to take the cheapest capital. One, it might not be from a very good capital partner provider, may have issues with that capital provider. Two, liquidity, cash is king. So I always tell my clients, take the most liquidity you can get and pay a premium for that. Now, I would say you always take the significant premium. It might not ultimately work by taking much more capital at a much higher rate or an imperfect structure, inefficient structure. But more often than not, you take the most liquidity you can when it's offered to you.
Yeah. Okay. Okay. And so with everything happening economically right now, I know that we have higher interest rates, the tighter capital markets, AI disruption. All right. Well, what do you think business owners should be preparing for over the next few years?
Well, I'm still struggling with that question myself, but I'll take a stab at it.
Okay.
AI is powerful and scary at the same time, and also probably both overstated and understated at the same time. So certain industries are going to be significantly disrupted. Certain industries are going to benefit significantly from it. And so I think you have to try to figure out what business you're in and whether there are AI tools that you can deploy in your business and integrate into your business. So getting intelligent about what's out there and how to properly use it, I think is an important skill to develop. Like almost any new technology, there are pluses and minuses, and they're not all, there's not one size fits all, but those who get ahead of the technology curve, or at least get smart about it and figure out how to work with it and employ it into the business and deploy it into your business, I think they're going to have advantages. Trying to figure out the balance between, in some businesses and industries, what AI replaces from a human capital standpoint. If you're just looking at it from dollars and cents, it might make sense to take some people out and use AI tools, but you have to think of the long term because it's not usually black and white like that. There are elements and nuances of having human capital in your business. And so I think the companies that are able to enhance their business with AI and AI tools are going to succeed. The ones that maybe get caught up in the sugar rush of I can get rid of all these people by putting using AI instead of the people may find themselves making a short-term decision to a long-term detriment. So I think, trying to figure out how AI applies to your industry and your business and how to get smart about it and how to, integrate and deploy those tools in your business, I think is going to be critical. And then, every industry is different, but being nimble and figuring out how to pivot is a skill in any time, right? But I think it becomes magnified when there's a lot of uncertainty. So the ability to kind of really know your market, know your business, know your options, and have contingency plans as to how to move with the market, depending on, once again, your industry, but I think is a critical skill. And I think people need to understand that, the best laid plans sometimes go to waste. And, the people who thrive and survive are the ones who are able to navigate, complicated waters, right? So easy to take a rowboat out on a calm lake, really hard to get to the other side when a storm comes in. And if you're not prepared, you get swamped. If you're prepared, it may be a very treacherous journey, but you get to the other side. And sometimes getting to the other side is the battle, and you win by surviving and thriving through adverse conditions. So I think we're potentially, I've been wrong so many times, but it does feel a lot like the late 90s or 2000 era, when valuations were crazy about companies that had almost no revenue, or they had very little substance but had tons of promise, and people were betting on the promise, and a lot of money was lost. A lot of money was raised. Valuations were crazy. Stock market went way up. It looked like there was an investment paradigm shift, but at the end of the day, companies that had substance and had true, revenues and operations and systems, they survived, and the ones that didn't evaporated. And it just seems like we're going into a little bit of that era. I mean, I just heard today that SpaceX is going to potentially go out at an IPO at 100 times revenue. I've never heard of anything like that. A $1.8 trillion valuation.
Yeah.
Supposedly that's close to the GDP of Canada.
Yeah. That's absolutely insane.
Doesn't seem sustainable to me, but who knows?
Yeah.
I've been wrong many times, but it just seems like we're maybe going into another significant distress period. And I think people need to be aware, be prepared, like any other, potential economic, natural disaster. Those who are prepared fare well, and those who aren't get caught short, and sometimes with disastrous results. So I think being vigilant and aware, not afraid, but recognizing that there's some potential storm clouds on the horizon, and trying to figure out what to do if a storm hits, and how to make sure you have the right cash reserves, you have contingency plans in case you lose a large client. I think that's those companies that are able to figure that out are going to fare well. Those who aren't, like many other times, they're going to probably cease to exist.
Yeah, yeah. So, what I really take from that is like a lot of the best preparation you can have is having some reserves, having a plan, and also just knowing how to navigate through the terrain. When you're out in the sea, if you have a proper plan and you're prepared, then you'll make it over to the side, no matter how treacherous the waters are. And right here, I really want to like switch gears here, because I know we're coming up on our time, and we always ask every founder, investor, operator that comes to our podcast the same questions on our operator stack. Because we're actually building a data set around how high level operators and decision makers think. So I'm going to run through these pretty quickly. It's
Sure.
5 questions, super easy. You spitball your answer, first thing that comes to mind. You ready?
Yeah.
Okay. All right. Question one. When you're making a high stakes decision, what's the first principle or filter or framework that you rely on?
I guess experience, just past can be prologue.
Okay, okay. Yeah, I love that. I love that. And what's the most common bottleneck you see consistently that you see consistently that prevents company from scaling effectively?
I think just having the wrong people in the wrong position. So not really thinking through your personnel, and really defining your management structure, your company structure, defining the roles, and making sure you have the right people in those roles.
Okay, I love it. I love it. And all right, three. You're doing great, by the way, Rick. What when eventually evaluating leadership teams, what's one signal that immediately tells you that someone's A plus talent?
Probably humility and the ability to listen, not touting his or her accomplishments at the outset, but kind of thinking, listening, hearing what you're asking them to do, or presenting them what the opportunity is, to ask questions and to listen.
Okay. Okay. And if you had to double the value of a company in 12 months, where would you focus first?
I probably look at my two things. I know I keep hitting this, but I really do think it comes down to the people. I mean, people is the very highest value. So having the right people, the right management team, the right people in the right positions. And then, your cost structure, really trying to pay attention to fixed costs, going to variable costs, particularly if you can variable cost outsource. So one of the things I try to explain to people is if you're in a business, you ought to look at things that make you money and outsource things that cost you money wherever possible. So maybe one example would be if you're in a distribution business, you shouldn't necessarily own your own warehouse, which, that's very expensive. It's very costly and it's a business unto itself. You might want to tap into somebody who's in the distribution, logistics, and warehousing business and utilize their skills, their capital, their resources, have that be outsourced, not owning that. I think people get caught up in thinking that value is created by what you own as opposed to what you create.
Yeah. Okay. Lastly, here, Rick, what's a mistake that you see founders or execs repeat over and over again that costs them the most?
I think it's just lack of objectivity and independent thought. So, founders often get caught up in what makes him or her very successful in the beginning isn't necessarily scalable when you get to a certain inflection point. And if you don't have, depending on the business, if you don't have independent advisors or an independent board, you can kind of get caught up in an echo chamber and kind of, drink your own Kool-Aid, so to speak. And it can be very fatal if you're not able to look at the bigger picture and have people who have different skills and experience to help enhance the core that you've created, the core value created by founding the business on your vision and your initial hard work. That gets you to a certain place, doesn't often get you to the next level without, some independence and some objectivity and some additional resources that are over and beyond your own echo chamber.
Yeah, yeah. So, look, Rick, this is extremely valuable here. I especially appreciate your perspective on how operational discipline, leadership, and even the opportunity when it comes to distressed investments right now in the market and the opportunity that may present itself within the next couple of years. So, I think a lot of people focus on growth, but not enough people focus on that resilience and sustainability that you spoke a lot about today. So, for anyone listening, I'll link the website for Fuel Breakers in the caption below. And Rick, any last words?
Well, just be careful out there. It could be could get a little scary, but don't fret. There's where there's storm clouds and distress and uncertainty, often it reveals opportunity.
I love it. All right, guys. See you guys on the next episode. Bye.
Thank you, Alyssa.